Hi, ladies and gentlemen. Good day and welcome to Sona Concall Q4 and FY22 earnings conference call. Please note all participant lines are in the listen-only mode as of now. There will be an opportunity for you to ask questions after the presentation concludes. Please note that this call is being recorded. We request that you place your lines on mute except when asking a question. Some of the statements by the management team in today's conference call may be forward-looking in nature, and we request you to refer to the disclaimer in the earnings presentation for further details. The management will also not be taking any specific customer-related questions or confirm or deny any customer names or relationships due to confidentiality reasons. Please refrain from naming any customer in your question. Now I'll hand the call over to Mr. Kapil Singh, Head of Consumer and Digital Commerce Research, India and Lead Auto Analyst at Nomura. Kapil, please. Thank you.
Hi. Good afternoon, everyone. Can I just request the panelists to keep their microphones on mute, please? Yeah. Good afternoon, everyone. To take us through the Q4 and FY22 results and to answer your questions, we are pleased to welcome the management team of Concall. We have Mr. Vivek Vikram Singh, MD and Group CEO, Mr. Kiran Manohar Deshmukh, CTO, Mr. Vikram Verma, CEO of the Driveline business, Mr. Sat Mohan Gupta, CEO of the Motor business, Mr. Rohit Nanda, Group CFO, and Mr. Amit Mishra, Head of Investor Relations. I will now hand over the call to Vivek for his opening remarks and presentation, which will be followed by Q&A. Over to you.
Thank you, Kapil, and welcome everyone to our Q4 and first full year earnings call. So if you recall in the last call, I said that December 2021 was likely the lowest point and that we expected to see a gradual improvement every quarter. Since making that statement, there has been a war in Europe, COVID lockdowns in China, further increases in material prices, energy prices, and inflation has become even worse. So in short, while our own business has done better sequentially, on the macroeconomic front have been proven comprehensively and completely wrong. So having learned our lesson that certainty is merely an intellectual vice at best, we are going to be far more conservative about what we expect to see in FY23. So we'll begin as always with the bad news. Material prices have continued and still continue to increase in the current quarter. So while we strive to mitigate this impact through revenue growth and cost management, we expect pressure on EBITDA margin to continue in the near term, which is the next 2-3 quarters. On the optimistic side, we expect FY23 to once again have the same kind of strong revenue growth that we demonstrated in the last few years. This growth would largely be led by new EV programs that we have already won and are starting during the course of FY23. We also, of course, will continue to endeavor and expect to win more orders and further strengthen our order book. And most importantly, we expect to make substantial progress on our technology roadmap, especially in the area of motors, where we intend to eventually develop and fit the right motor made using the right technology to each and every vehicle application, from small electric two-wheelers to electric trucks and buses. Coming to this quarter specifically, while the financials, like I said, are much better on a sequential basis, on a YOY basis, we are largely flat on revenue and EBITDA. The positive here is that our reported net profit, which has grown by 75%, Now, this includes a significant one-time tax benefit, while the corresponding quarter of the last year also had an exceptional IPO expense. However, even after adjusting for all of that in both quarters, we have a healthy growth of 11%, which Rohit would explain later. Now, I know that from the outside, a 2% growth in revenue and 11% growth in profit seems wholly unremarkable and may not seem like much. But the way we see it, it's an immense display of steadfastness in the face of unprecedented headwinds in our industry. And I'll touch upon this a little later as well. But the biggest reason for this, apart from, of course, our fantastic team that you see here on the panel, is our BEV revenue growth, where we have more than doubled our revenue and reached 29% revenue share this quarter. For the full year, we would like to share our performance scorecard with all of you, our bosses, our shareholders. So there are 5 KRAs that are important for us as a company: our financials, electrification, business development, diversification, and new product development. So I'll start first with the financials. We believe we have done well on all 3 KPIs that we value: growth, margins, as well as returns. We've achieved 36% growth in revenue, 27% growth in EBITDA, and 68% growth in net profit in this year. And I know again there are one-time exceptional items in the net profit. However, even if you strip that off, still we have 36-37% year-on-year growth, which is quite healthy. Now, any company's performance only has meaning when seen in the context of the industry or the environment it operates. Being a global company with majority of our revenue coming from light vehicles, the best benchmark for us to compare performance is global light vehicle sales. So in this shrinking market, which has declined by 7%, we have outperformed our industry by delivering 75% of purely organic growth in the last 2 years. Now coming to our second KRA, which is electrification. So first I'll talk about the lag indicators, what has already gone by in this year. So our BEV revenue share has increased to 25% from 14% in FY21. BEV revenue in absolute terms has grown by 2.5 times to over 500 crores. The lead indicator, which indicates future potential, is the number of EV programs. In this KPI, we have doubled our number of programs from 15 to 30. Just this quarter, we've added 6 new EV programs from 5 new EV customers. We have won 2 programs to supply starter motors for the PHEV or plug-in hybrid electric vehicles for 2 new customers, one in Europe and one in Asia. Now, these orders are important because they reaffirm what we have been saying for a while, that starter motors are applicable in all hybrid powertrains regardless of the engine size. Coming to India, we've won a motor program from a new electric 2-wheeler customer, an EV differential gear program from a new electric commercial vehicle customer, and an EV gear program from a new electric tractor, a new off-highway customer. We've also won an order for a new driveline product called spool gear. This is from an existing global EV customer, and this win, although not very large in commercial terms, is perhaps a single biggest achievement of this quarter. Because what this shows is that we can now develop products and sell them beyond our domain of traditional differential assemblies. So what we've demonstrated is that now all EV transmission solutions for all types of BEV architectures are in our skill set, and Mr. Deshmukh will elaborate on this capability addition a little later in the presentation. With this, we have reached now 30 EV programs across 19 unique customers. And from a lead indicator perspective, once again, the fact that 21 out of the 30 programs are not yet in serial production demonstrates how much EV growth is yet to be realized, so and how much dry powder we are actually sitting on today. Our third KRA is business development. So this is an annual thing, so we will like to present that in the last 3 quarters, we have won 43 new programs in total and added 10 new customers. And I'm quite proud to say that we have added 2 new global top 10 passenger vehicle customers. So now we can say that we serve 7 of the top 10 global car makers of the world. The total value of these order wins was 76 billion rupees, while the net addition after accounting for orders consumed comes to 46 billion. Which very neatly brings me to our net order book, which at the end of FY22 stands at 186 billion or around $2.4 billion. And in addition to the 6 EV programs we discussed earlier, we've added several programs for non-EV applications also. Also may be interesting for you to note that we now have 3 EV programs for commercial vehicles and tractors, which shows that electrification is going beyond just cars and two-wheelers now. Our fourth KRA, diversification. Here, as you can see, we've made significant progress from FY21, and now more than half of our revenue comes from BEV and hybrid/micro hybrid powertrains, while ICE-dependent revenue has decreased to 18%. BEV share increasing from 1% to 25% in just 3 years kind of underlines the speed of the EV megatrend and how we as a company have adapted to and benefited from this trend. Moving on to revenue breakup by geography. There have been higher disruptions relatively to customer production schedules in North America and Europe during the last year, FY22, which is the reason our mix has changed. But overall, it remains balanced across all 4 major markets. And as I said, I think in the last call, this mix will keep changing from quarter to quarter depending on the performance of these 4 markets and more critically, our customers' performance in these end markets. On products, our revenue share from differential assemblies has grown from 5.6% in FY20 to 27% in FY22. We've added 3 new products in FY22 that Mr. Deshmukh will soon highlight. So this chart will keep evolving as we evolve from being a component and subsystem supplier to being a powertrain solution provider. Finally, on the vehicle segments, there are, I would say, 3 inferences. CV demand has started to recover, and hopefully we will see far more from that segment. And while the off-highway industry declined largely in India last year, it is now showing good growth early in this year. Thirdly, our efforts on the traction motors and controllers have started showing some results, with electric two-wheelers and three-wheelers reaching 1.5% of our revenue in FY22, and hopefully they become high single-digit during FY23. With this, I turn the call over to our Group CTO, Mr. Deshmukh, to discuss our 5th and most important KRA, our new product development and our progress on technology. Over to you, sir.
Thank you, Vivek. Good evening, ladies and gentlemen. Our extended technology roadmap presented during the last earnings call addresses revolutions in mobility, electrification, and automation. Our vision is to become a significant player in electric vehicles, autonomous and connected vehicles, And the roadmap displays these very intentions. This map shows our past, present, and future product offerings depicted by the dark area in the bottom center for our legacy core products, the blue for the products we developed in recent years, and the white for our operations for the future. White region are currently under development in our R&D sectors. So as we progress on our technology roadmap, products from the white area move to the blue area. In FY22, as we mentioned, 3 products have entered the blue zone: integrated motor controller module for the predictive active suspension, spool gear, and epicyclic gear set for EV drivetrains. The first has allowed us to expand into the growing autonomous and connected space, and we discussed this last quarter. The introduction of the other products has extended our reach in the EV drivetrains varying architecture. Let me elaborate this in the following slide. As more car makers introduce new electric vehicles, new architectures emerge. Depending on the specific application, design constraints, and manufacturing considerations, EV drivetrains have evolved into 4 different architectures.
Mr. Deshmukh, can I request you to speak a little louder, sir? It's muffled.
Sure. So, depending on the specific application, design constraints, and manufacturing considerations, EV drivetrains have evolved into 4 creations, where one motor drives 2 wheels. We need a mechanical differential to enable the wheels to turn at different speeds when the vehicle makes turn. Where one motor drives a single wheel, we need a compact, high-efficiency gear reduction unit that is all required. Our final drive differential assemblies are already fitted in 1 and 2 motor configurations of mass-manufactured EVs. Spool gears and epicyclic gear train developed by us offer the demanding features of electric vehicles. They find their relevance even in the absence of a mechanical differential. They also have a broader application in commercial vehicles, gearboxes, and hub wheel reduction units. While 1 and 2 motor architecture is likely to be the most prevalent configuration in the future, now we have solutions for every format of the electric drivetrain. Alternate architectures, although more sophisticated, are more expensive, and hence we also realize higher value per vehicle than the differential assembly. Our proven ability of commercializing new products also keeps increasing our content per vehicle, and in the long term, we are not restricted to just the TAM of a few products. Next slide. So as the electrification of mobility spreads across the segments, we are seeing a massive opportunity for traction motors from boats and industrial automated guided vehicles to large electric buses and trucks. Every application is different, its requirements and demands are unique. We are developing multiple new products by mapping the right technology for the correct application. Since the technology spectrum to address the entire marketplace is too broad, we are supplementing our strong R&D efforts with strategic partnerships with other leading technology companies. In July last year, we partnered with IRP of Israel to co-develop a magnet-less motor for electric 2 and 3 wheelers. The developmental work is progressing satisfactorily, and we hope to have a working prototype soon. Recently, we formed a strategic partnership with Anytime Inc., the Canadian technology company that was incubated at McMaster University in Ontario. Anytime specializes in next generation switch SRMs, electric propulsion, and electrified powertrains. Anytime's novel switch reluctance motor advanced control will help us develop high efficiency and high performance magnetless motors. This is yet another step forward, offering environmentally sustainable and cost-effective solutions to our customers. Today, we announced a partnership with C-Motive Technologies, a high-tech electric motor company based in Wisconsin, US. Traditional electric motors use electromagnetic forces to convert electric power to mechanical power. C-Motive uses electrostatic forces to build a motor through a series of multiplicative gains in mechanical, electrical, and electrical applications. These motors deliver high yet ripple-free torque without active cooling, very little copper, and no rare earth metals or Sona Comstar and C-Motive will collaborate to develop electrostatic motors for EV applications, for which we estimate the serial production will likely start in 2026. One of our top strategic is to grow our EV revenue. We will accomplish this by expanding our traction motor offerings, addressing the entire range of EVs, spanning from below 5 kilowatts to above 300. With that, I will hand over to Rohit to cover the financial update.
Thank you, Mr. Deshmukh. Very good day to you all. It's my pleasure to share our fourth quarter and post-listing the first full year financial results with you. We'll start with our fourth quarter revenue, which grew by 2% to 550 crores on a year-on-year basis. BEV revenue continues to lead our revenue growth with an increase of 104% for this quarter, and it constituted 29% of our total revenue. Global headwinds from continued semiconductor chip shortage, conflict in Europe, and inflationary pressures acted as a drag on the non-BEV revenue, in line with the general decline in our key markets of Europe and USA. Before I talk about our EBITDA and margins, let me spend a minute to show how commodity price inflation is impacting our margins adversely, even where a full material pass-through is available to us. Prateek, may I request you to put up the margin illustrations? Yeah, this one. Thank you. We presented this slide before, but for the benefit of the first-time participants, even at the cost of repetition, I'll explain it through this illustration. As you can see, for a product selling for 100 rupees, having a material cost of 45, when material cost goes up by 15%, even in case of a 100% material price pass-through, the margin percentage drops by 3.5% in this example due to arithmetic effect, as selling price and cost both go up by the same amount. Although the absolute margin in this case remains unchanged at rupees 55. Prateek, you can go back to the main slide. So this was essentially to demonstrate how commodity price inflation impacts the margin percentage, even in cases where a full price recovery is possible. Now moving on to discussion on EBITDA, which was 135 crores for the quarter. EBITDA margin for the quarter had a positive impact of about 2% from a better product mix. However, commodity price inflation continues to be a drag. Year-on-year impact of higher raw material prices was about 3.4%, out of which 2.6% is purely due to arithmetic effect, despite commodity pass-through to the customers, which I just demonstrated through an illustration earlier. Our PAT is at 105 crores for the quarter. It grew by 75% on a year-on-year basis. but it includes some one-time tax impacts, including some large income tax refunds and interest on income tax refunds. Similarly, if we compare it to the fourth quarter of last year, that also had some exceptional expense. So on a like-to-like basis, if we compare, our PAT has grown by 11%. So adjusted PAT for the current quarter would be 78 crores against 70 crores of the same quarter last year. Yeah. Moving on to the full year financials now. Consolidated full year revenue for the company was 2,131 crores, a growth of 36% over last year. BEV revenues at 504 crores grew by 145% and constituted 25% of the total revenue for the full year. Our non-BEV revenue also grew by 20% despite a general market decline in our key markets of Europe and USA. Full year EBITDA was 559 crores, showing a growth of 27%. EBITDA margin for the full year stood at 26.2% and had a positive impact from a better product mix, about 1.9%, and operating leverage of 1.4%. EBITDA margin was adversely impacted by higher commodity prices and lower forex gains in FY22. RM prices had an adverse impact of 2.9% because of arithmetic effect, despite the material price pass-through. Additional adverse impact of 1.2% came from the portion in which price pass-through was not available to us contractually. PAT for the full year is 362 crores, showing a growth of 68%. To do a like-to-like comparison, we've shown adjusted PAT for both years after eliminating impact of exceptional income expenses, one-time tax impact, and interest on income tax refunds received. So adjusted PAT for the year was 309 crores, which has grown 37% with an improved transmission from EBITDA to PAT, mainly due to lower finance cost. Since it's our annual presentation, we'll also briefly touch upon the cash flows for the year. The company generated 445 crores of operating cash flow, out of which 344 crores, which is about 77% of the amount, was plowed back into capex for our future growth. IPO proceeds, which we raised during the year, were used for paying off the outstanding debt of the company, and as a result thereof, the company had a negative net debt as at the end of the year. Even after payment of a dividend of 45 crores during the year, we've ended up at a cash balance which is higher than where we began the financial year. Moving on to the key ratios, our value addition to employee cost ratio further improved for the year to 5.7 times as compared to 5.2 times last year. We've explained earlier also that we track this ratio very keenly as it is an indicator of an improvement due to the positive operating leverage for the company. Return on capital employed and return on equity ratios continue to be robust at above 30% as it was in the past years. Net debt to EBITDA ratio as at the end of the year was negative, like I said, due to negative net debt. And as we continue to incur capex in the current financial year, it is expected to eventually turn positive. Working capital turnover ratio was constant at nearly 4 times as it was in the previous 2 years, whereas fixed asset turnover ratio is a tad lower at 4.7 times against 5 times last year due to new capitalization during the year. With this, it brings us to the end of the Q4 earnings presentation, and I'll now hand the proceedings back to the Nomura team.
Yeah. Hi, Shaipur, can start taking the questions.
Okay, thank you. We will now open the floor for the Q&A session. If you wish to raise a question, you can use the raise hand function located at the bottom right of the WebEx page. We will unmute your line and prompt you to speak, or you may submit your questions via the Q&A chat box addressing to all panelists. A gentle reminder to keep your questions to a maximum of 2 questions. If you have more questions later, please return to the queue. Thank you.
Hi, Vivek. By the time, I'll just ask a couple of questions. So firstly, we've shown slide 20, I think it was, we have shown a technology roadmap for the motor business. And we've won some other new orders as well. Where do you see the largest potential when you do crystal ball gazing over the next 4-5 years for yourself from where you are today? Which segment do you think will uh, uh, grow the largest? I think you're on mute.
Right. So growth has two connotations. I mean, if you have a low base, growth as a percentage will be very high. For motors, that is always going to be because traction motor business, just 1.5%, right? So that's what, 35 crore or something of revenue. That's nothing. So we will grow very, very fast in that in the next 3-4 years because it's just begun. Driveline, let's say we have about 450, 460 crore or perhaps 470 this year. That as a percentage may not grow much, but it will significantly ramp up because of two reasons. One, vehicle electrification itself as a trend gets us there, right? If you have 1/8 of the market, if it goes from 4% to 50%, you benefit from that anyway. Second, if you've noticed, this is why I called it the single biggest achievement of this quarter. We started from being a differential gear company, then we became a differential assembly company, then we said differential assembly plus one reduction gear. But you know that in the whole transmission, there are a bunch of other reduction gears and other things. With the spool gear addition, we have basically said that now we can make EV transmission gears. So we have literally opened up the whole addressable market of differentials. The reduction market or transmission market is perhaps larger than that. So yeah, that field now can just suddenly accelerate because every architecture needs reduction plus differential, and we got it covered. So yes, it is exciting times.
Sure. So I take it that the driveline business in terms of revenues will have a maximum addition.
Yeah, I mean, look, we don't give future guidance, so I won't give numbers. Plus, it is the surest way to disappoint people, right? That you overpromise and then you don't end up delivering. But we have given over the last 7 years about 35, 36% growth on an average. I don't see any reason, non-macroeconomic reason. There I'll caveat. I can't prevent wars. Non-macroeconomic reason for that to not continue in the near future.
Sure. So let me ask on that topic as well, because a lot of investors want to know. There were a lot of chip shortages which affected us during the last month. How are things progressing from a ramp-up perspective now?
So I think the first time, Kapil, you did only ask me. First time we did this was in August, right? Last year, and I'd said 18 months. And that time, I think when we said 18 months, people are shocked that why is this person so pessimistic? So let me just put a caveat. We're not pessimistic or optimistic. A company's management's role is to transparently, truthfully, clearly tell you what we know to be true. The decisions on investment, etc., are the investors. The decision to analyze is of the analyst, but don't read too much into the psychological bearing of the statement. It isn't. It is the truth as we see it. We thought it was 18 months. I think with all that has happened in the last quarter, maybe we add 3 to 6 months, but it stays where it was. The semiconductor chip problem was not an easy problem to solve, right? It is a multi-industry, multi-capacity problem where the supply-demand mismatch is not shortening because the demand is also continuing to increase. Now, there is a chance that given all the central banks' actions in the next few months, demand might cool a little and the demand-supply gap can narrow. But still, I don't see that happening. At least 12 months, we've still got ahead of us to weather this.
Sure. Yeah, now we have the question from Nitin. Shaiwa, can we take Nitin? Nitin Arora?
Yes, please go ahead. Thank you.
Hi, Vivek. Hi, so much for taking my question.
Hi, Nitin. Nitin, I can't hear clearly.
Okay, are you able to hear me now? I'm audible?
Yes, better.
Okay. Okay. My first question is, on just a question which was Kapil was asking. So, the good news when you say, the revenue growth should be doable, the order book is very strong. This is in context, I'm asking this because, what we read through global reports is that war is still on, there is some issue of neon gas, and the war is still on, more than last 3 months, 4 months. Do you see a scenario of, further panic in the production of the chip shortage, which can impact, most probably after Q1, Q2? Where this confidence is coming of the revenue growth, right? That's my first question.
Okay. So Nitin, I'll try to answer. The line is not very clear, so I will paraphrase. One, you're saying, will the chip shortage get worse because of what is happening in Europe with the war situation? The answer to that is not really. It is where it is. I don't think it's getting worse or better. The factors that are affecting it are beyond that situation. Second, I think it's important to differentiate when I'm asked or when we are asked about industrial or macroeconomic issues like chip shortage, we are answering to that question. How much will it affect us is a different matter. We don't look at the world only through a lens which is focused on Sona Comstar. It is on the chip shortage issue, so I answered that. That's why I think in the initial bit I did mention that regardless of all the known problems, right? The war in Ukraine, the material costs, the lockdowns in China because of COVID, the freight problem. Despite knowing all this, we expect FY23 to still have fairly strong revenue growth for us as a company. As an industry, I doubt there'll be strong growth in sales.
Got it. That's very helpful.
So Nitin, basically everything is new programs only red growth. We have assumed that things will stay as bad as they are. No industry tied to help us. We are on our own. Whatever we make, whatever we will eat. So it is all new programs and new customers. That is all that we are looking at.
Got it. And sir, really, the way you started on the margins, so our band has been 8%. Do you see further pressure on this band in terms of margins for FY22?
Nitin, I really can't tell what. Kapil, could you?
I think he's asking whether you see further pressure on margins because of the commodity cost inflation.
Yeah, so I mean, we are where we are in the last quarter. If anything further happens, I'm not going to try and guess because it hasn't happened. But with what we have, we can sustain. I mean, if you look at it, despite all of this, right, we still did our 26% for the year. So we can't promise on every quarter, but if you take the whole year, the effects of operating leverage also get realized. Forex up and down also gets neutralized to some extent. So yeah, I mean, if you look at the full year, I can say that with far more confidence. Quarter to quarter, there can be more variation.
Was there a forex gain in this quarter?
Very little. Compared to last year, it was much lower. So, Rohit, would you like to take that? I don't remember, but it was little.
Yeah, it was 2 crores for the current quarter.
Yeah.
Thank you very much, sir. I'll come back in the
Thanks, Nitin.
Hi, Gunjan. Your line is now unmuted. Please go ahead and ask your question. Thank you.
Yeah, hi. Thanks, team, for taking my questions. Just follow up on the order book. I'm not sure, Vivek. I think my voice is echoing. Is it okay for you all?
No, perfectly clear. This is the clearest voice we've heard. This is Gunjan, right?
Okay.
See?
Okay. So my question is on the order book, because if I look at the order book, versus last quarter, of course, the EV book is kind of stable, whereas the non-EV book has seen a pretty significant jump. So I'm just trying to understand, where is this coming from? Is this the plug-in hybrid? The wins that you spoke about. Maybe just give us a little bit color on, the sequential change in the order book that we have seen, and follow up to the spool gear which you mentioned. When does it commercialize, and what does it do to the content value? Those two questions.
Sure. So Prateek, you can take us to the order book. So the plug-in hybrid, so the order book EV part contains all plug-in vehicles. So as you can see in the note, I don't know if the note covers that. No. It is BEV plus plug-in hybrid. So those are in this actually. In the non-EV side, we have some new order in the passenger vehicle space. I think I did mention that we have added we've added two new large automakers. They are in the top 10 automakers of the world. So for traditional differential gear business, so that has added that. Does that kind of answer your question?
So no, I'm just trying to understand, why was the EV book then order book stable? I mean, if I look at it was 116 billion last quarter, and then it's kind of marginally come down this quarter, and you spoke about all these wins. So I mean, intuitively it would have gone up.
Sorry, net order book, which is why. So I'll go back into the concept. We have also consumed orders in this quarter, right? And most of that has come from EV only. So if you look at our non-EV revenue, it has declined. Only our EV revenue increased. So there are some programs that hit maturity. So you take them out of the order book. Go back one slide, Prateek. Just the program slide. So if you look at last quarter, there were 7 EV programs that were in serial production. Now there are 9. So 2 of those programs, the value has gone from order book. Now they are only in serial.
Okay, got it. I got it. Plug-in is there in EVs, and non-EV is more the traditional. Okay, I got it.
Second part of your question was spool gear. Okay. So look, I think I've answered this before. The traditional, Prateek, can you go to the 1 to 2 motor architecture, Mr. Deshmukh slide? Yeah. Okay. So if you look at the first architecture, 1 or 2 motor architecture, this is going to be the dominant form for most vehicles. 90 to 95% of all electric vehicles in the next 5 to 10 years should go with this architecture. The spool gear architecture is for a 3 motor configuration, which is required for high torque vehicle, which means either very high speed or high weight or off-roaders. Not too many of those. Expensive solution, because you put in 3. Value content per vehicle is very high, and I can't give it away without giving the price, so I won't go there. But see, the final drive differential assembly is there in the front axle. It is perhaps so a single one, it is 3 times nearly. Let's put it that way. The spool gear version. However, Gunjan, the volume will be low. These are expensive vehicles. This is more a capability thing, and this is why I was saying that look at it more as a capability addition, because this doesn't have any differential. What this says to you as an analyst is that we have been saying this is the total differential assembly market. They have 12.5% market share. But there is a market out there for reduction gears or transmission of the EV, in which we had till now 0%. Well, now we enter this, right? That's the point. So the orders won, production will start next year.
Okay, just one more I can pitch in, maybe Rohit. Just the follow up on the margins. Now, can you just share some color on how typically the contracts for, aluminum, how quickly they can get repriced? Because clearly there's still more pressure on the aluminum side. So maybe some color on how should we be thinking about the margins?
So aluminum and copper, most of the contracts for motor business would be with a lag of 3 months. Gunjan, could I explain?
Okay, so the pressure, the surge that we have seen, we will see the the hit of that in Q1 as well on the motor business.
Yeah, from previous quarter, positive will also come in, right? Because it's a 1 quarter price lag. So it will partially offset. Because the prices are on an increasing trajectory, right? So they would have increased in the quarter prior to that as well.
So it's a rolling settlement, Gunjan. As it keeps going up on that slope, every quarter, the next quarter will be the settlement one. But again, I don't think it could be that significant, to be honest. Steel is the one you should look at as an analyst because steel affects both divisions.
Correct.
But all of that with a lag of 3-4 months is passed through, right? Or is there anything that is not a pass through and which will happen, which will adjust, which will take time to adjust?
Motor business, steel input, that's a pass through only in a smaller percentage of customers.
Okay, got it. Thank you.
Thank you.
Thank you. Hitesh, your line is now unmuted. Please go ahead and ask your question. Thanks.
Hello. Yeah. So thanks for giving me a chance to ask a question. Vivek, my question is on your largest customer in PV has faced certain lockdowns in China because of COVID, right? So can you give us some update on the production ramp up there?
As I think we've requested multiple times, we don't take customer specific questions. Sorry.
Okay. Any view on the China lockdown situation about your orders from there?
Actually, it's not just that. So we took a big hit last quarter. I think March was a bad month, completely washout type month. As you know, China is it is our fourth largest market, right? But I think the problem not just local. So we must all pray that the problem gets resolved not just as a humanitarian crisis. I do feel for people there who are locked up in their houses, but beyond that, I think supply chains and trade is going to take a massive hit all over if it doesn't get resolved within May. See, we make controllers, and for us, because we are seeing it firsthand, a lot of the supply chain runs through there, right? The semiconductor, the chip stuff. Our customer supply chains, almost all of them, if you look at automotive world, how many of their supply chains go through China? And if China stays locked down for too long, it's going to have a massive ripple effect. So that is, I would say, a larger concern than one particular customer or one particular market. The impact of China being locked down on the global automotive value chain.
And yesterday actually Volkswagen also alluded to the same point that you are highlighting, but it was more of a European impact on the supply chains. Is the US also getting impacted because supply chains?
Which country, which car, if you take and say that it does not pass through China, any vehicle, I doubt it. So it's a global problem. I think I didn't hear Mr. Dees's thing, but he's perhaps coming at it from a European angle. But because we are in Europe and US both pretty fairly significantly, it is everywhere. If it resolves within, let's say, the next 3 weeks, I think we all will be relatively unscathed and we'll get through. But if it doesn't, then we have a problem.
Great. Thanks. Thanks for that. Thanks, Vivek.
But I'm getting good at recognizing
Hi,
people
Ken.
from their voices.
Hi, Chen.
Sorry, go ahead.
Your line is unmuted. Please go ahead. Thank you.
Yeah, hi, thanks. Couple of questions from my side. First of all, congrats on good performance. Can you share some details on the geographic restrictions on the tabs with Anytime and C-Motive? Is it only for India or this would be for the geographies as well?
Good question. Mr. Deshmukh? Mr.
I think
Deshmukh?
Mr. Deshmukh is dropped for some reason. I don't see him.
Okay. So I'll try and answer that. So anytime, no restrictions. The applications could be very far ranging. This is not a traditional automotive type of product. I don't know how much is known about electrostatic, but in our spirit of trying to reduce more and more from the motor to make it more efficient, this has nothing actually. It's dielectric fluid, and we are going back to Benjamin Franklin times. Right now, it's very low speed and high torque is what that motor can deliver. So for automotive, it's not actually a right fit in its present shape because, as you know, automotive, the wheels have to rotate at a fairly high speed, so it's high RPM. What we will do is, and we are going to be investing in them as well, we are going to together try and adapt this to automotive and mobility applications, because if we can, I mean, can you imagine, Gunjan was just asking about copper, and we are so worried about 3%, 4% movement in copper. If you can just eliminate all copper and all magnets, you can have potentially, and I'm using my words carefully, I don't want it to be said as, talking too big, but it can be a potentially industry changing device. So let's see.
Mr. Deshmukh is back.
Okay, good. It is a moonshot, but it's a global collaboration. Anytime is far more near term in that sense that the motor exists. The issues that switch reluctance motors had in delivering that kind of torque and power without a magnet, there were problems around weight, there were problems around torque ripple. Those have been sorted out by this company. Here, Mr. Deshmukh, I think the question is about, is there a geographic boundary to the Anytime partnership?
Yeah, I was able to hear, but I was not able to come on. Well, there are boundaries in the sense that the current agreement is for India specific, but it is not limited to India. In case there are specific markets, specific requirements from outside India, we can address that, which would be on a case-to-case basis. But essentially, it will focus on India and probably Southeast Asian markets.
Got it. And C-Motive, as Vikram indicated, Vivek indicated, is primarily there's no restriction on geography as such.
Yeah, this is like Vivek mentioned, it is a moonshot, and we hope that we are able to convert that into a automotive application, mobility application. And if that happens, I think the entire world is there.
Sure. Okay. And a couple of other questions for Rohit. So one is with respect to capex for FY23, what should we look at? And secondly, you talked about interest on income tax refund. So is that part of other income, and how much that would be?
Yeah, so I'll maybe answer in reverse. So income tax refund interest is part of other income, about 16 crores for the full year. Okay, and coming to your capex question, look, what's happening is that because of all these uncertainties in terms of the deliveries, etc. What we've experienced in the last 12 to 18 months is that machines which used to get delivered, say, earlier in 8 to 9 months are now probably taking double the time. So in that sense, the time span over which the capex is happening is kind of elongated. So rather than, I would say, mentioning only of 1 year, we will probably look at a period of 3 years. And given the current order book, I think we should be spending about 900 to 1,000 crores between 23 and 25. FY23 to 25, 3 years, about 900 to 1,000 crores.
Got it. Thanks. I'll come back in queue.
Thanks, Suresh.
I'll read out a few questions we got in the Q&A box. So firstly, you have partnered with Anytime for SRM and static drive motors. Will these products be competing with the same market and use case? Also, will they cannibalize the share from BLDC and PMSM motors? And secondly, do you have customers for BSG product and integrated motor controller module? Vivek, you're mute.
Yeah, IMSM is with a customer. We even gave the order value last quarter, I believe. So that is in our earnings presentation of last time. BSG, we still don't have a customer. Otherwise, it would have been in that order book we would have announced. And what was the first part of the question? Anytime? No, there is no cannibalization. Let's try to look at, I think Mr. Deshmukh showed a very nice chart. Every end use application has a different need. Sub $1,000 electric two-wheeler, for example, the need is how many lifetime miles can you deliver on that device upon the TCO of that device. That's basically it. Above $1,000 price range, the electric scooter also has to deliver higher acceleration, higher torque, and a host of other features. Aesthetic elements also place a value. The powertrain has to cater to that end application. See, in the end, all of us in the automotive industry, whether we be suppliers or OEM, are solving the problem of the end consumer. The end consumer for an electric three-wheeler L5 type of vehicle has a different requirement. That is lifetime miles into lifetime kilograms hauled upon the total lifetime cost. That is what you're trying to maximize, not 0 to 100 in 2 seconds or 3 seconds, because, I mean, unless you're an auto driver in Chennai, you're not trying to set speed records, right? It is different needs. You need a different kind of end products. For that different product, what we try to do is try to select the best technology for that product. Cannibalization, etc., is I think more a very FMCG word in which you have 60% market share and at the same price point you have two things, etc. This is a nascent market growing so fast where we already don't have 100% market share that those questions are meaningless. Right now, the objective is to try to give our customers the best fit product for that end application. And within a category also, there will be multiple end users. So let's say an electric LCV, as you know, today, earlier in the day, one was launched. We believe that math of kilometers upon lifetime cost of those set kilometers, the electric LCV and L5 cargo carriage already is economically more beneficial to be electric. And the whole market should convert. In that time, the objective is not this, that we know how to make BLDC PMSM motor. Let's try to make as many variants and try to give it to our customers. It is not selling by push. This is a business you sell by pull, which is you develop the best end technology product. And if you build it and you build it well, customers will come to you. And that is what we are trying to do. We will fill this map with each space would have its own best fit product according to us. It's our opinion, we may be wrong, but what we feel is the best thing, we will provide for our customers. That's what our attempt is. And if we are good enough, all the things like market share, revenue, all of that will follow. That's the result, that's not the process.
Thank you. Ronak, your line is now unmuted. Please go ahead. Thank you.
Yeah, hi. Thanks for the opportunity. Vivek, am I audible?
Yes, very clear, Ronak.
Hi. So Vivek, a question on the traction motor part of the business. Firstly, can you give some highlights on how the industry production was for the domestic market in the last 12 months? Where are we in terms of market share? How do you see the competitive intensity? Because volumes are inching up pretty sharply. And how do we see the industry ecosystem developing in the next 2 to 3 years?
So actually, it's a very good question, Ronak. And I know some of you have to go for another call, so I'll excuse that. But do you tune in to Gunjan is hosting us at the BOFA EV thing, and I will talk about this subject at length. I think there is a supply constraint, Ronak, and I think you know the answer. There is a big supply constraint. The demand is phenomenal for the E2-wheeler, E3-wheeler, and I think the E4-wheeler LCV segment. Any device or any vehicle which has a high asset utilization is easier to justify economically because the OPEX is so much lower than IC vehicles. I think this market will just explode and there is enough. On our market share, I think we're doing about 10,000 motors. So, it should be easy to estimate. So we're doing 10,000 right now per month.
Okay.
So it should be easy to estimate market share, I guess.
Right, but what would be the overall domestic production in that sense, and how much is import here? Any color on the industry side?
So how much is import in the electric two-wheeler one?
Yeah, two-wheeler, three-wheeler, or how do you see the market?
Look, I think FAME 2 will get more rigorous. They will start checking value addition and localization at tier 2 level also. And more will move local. I think the day of showing value addition in India by importing something, repacking it and giving it to customer, I think those days are numbered.
Sure. Perfect.
It is a high boost for local, Ronak, and I think as a community, there are a lot of people who stand to benefit, even on powertrain as well as balance of parts.
Right. Perfect. Thank you. Thanks a lot.
Hi everyone. Due to time constraints, we would have to keep that as the last question. Vivek, I will hand over to you for any closing comments.
No, thanks, Kapil. I mean, look, I know you guys have to go, but I'm here. Please do let us know if you have any other questions. Thank you to all of you for attending. First year of our reporting results as a listed company, so I'm sure we have much more to learn and further improve. We'll try. Should you have any further questions, feedback, please feel free to reach out to us or CDR India. And thank you. Best of luck, and hopefully we show even better results next quarter. So, thank you.
On behalf of all of you, taking out time, and look forward to same kind of success as well. All the best.
Thank you.
Thank you. Thank you very much.
Thank you.
Thank you.